Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching this video on Procter & Gamble. Now, this channel is dedicated to the rational investor, and that is an individual who values a company's intrinsic value based on its cash flows and compares that to the selling price on the market and looks for a gap between the intrinsic value and the market price that you can buy it at. And hopefully, by holding it over the long term, that gap will close and we will realize an economic return. Now, we look for a company that has 5 key attributes to qualify for a solid investment. Those attributes are top-line revenue growth, earnings growth as we define it by EBITDA, free cash flow growth, a strong balance sheet, and a well-priced stock. The well-priced stock being one of the cornerstones of a solid investment is not paying too much for the growth. I'd ask you to go look at my Domino's versus Google video to give you an idea on how Domino's outperformed Google since its IPO. Because it IPO'd so cheaply, it really has an impact on the long-term economics, much more so than growth. But enough about that. Let's dive into Procter & Gamble. Look at the brands, look at the company, look at the financials, figure out where we think it's going to go in the future and what the return might be by holding it. Behind me is their 10K. I highly recommend you read them. You can find them on secsearch.com. Type in any stock, pull down the 10K. You can also go to the company. Their investor relations website will have it. What's interesting about Procter & Gamble is the brands that they own are hallmarks of American consumer society, right? Brands like Tide, Gillette, Bounty, these are hallmarks of what you would find in a grocery store and are purchased every day, and it's very defensive, and I can see why it would run up recently with the COVID as people are jumping into brands they believe are defensive. So let's go through and look at some of the other brands that they have just to familiarize ourselves quickly with the company. So personal care is a big sector for them. They own brands like NyQuil and Pepto-Bismol. Oral care, Crest is the biggest one they have. Brands like Tide, Bounty, diapers, Dawn, so forth, as well as Old Spice and Gillette. Monster brands. They do a lot of M&A activity. You read through the 10K. It's extremely rosy. It's very complimentary in terms of the way they grow and what they do. And a lot of churning and activity, both buying and selling of brands to hopefully position the business for growth. All right, let's go take a look at the financials and then see what we think this business might be worth. So behind me is about a decade of revenue and earnings data. So we're going to look at the first 2 hallmarks of a solid investment. That'd be top line revenue growth and earnings growth. Let's take a look at revenue. Revenue in 2011 was $83 billion. It has decreased to $67 billion over that roughly 9-year period of time. That's definitely not a hallmark that we want to see. I was surprised to see this. Reading the 10K, they sold their Duracell division to Berkshire Hathaway, and they've bought other businesses, but for some reason they seem to be capped out, and over the decade have done nothing but decline in revenue. So just off the top, I would expect this company to be trading at a cheaper multiple because it's basically a dividend play. But let's keep going and see where we get. Operating income, right? We started operating income, then we add in depreciation to get to an EBITDA number. You'll notice here I'm adding back $8.3 billion. They took a write-down on goodwill related to their Gillette business, and so I've added that back because it's a non-cash transaction, and we're trying to get EBITDA as a proxy for the income or the earnings of the business, and these earnings should represent a steady state, kind of annualized run rate, and $8 billion write-downs don't happen all the time. So I added it back, and you can see $18.6 billion to $16.6 billion of EBITDA. That's a negative 1% annual growth rate. So we have a problem here. We've got a business which is declining, and I tell you, I was shocked to see this as a main staple of the S&P 500, a company with brands that everybody knows. I was a little surprised to see that they are in fact declining both in revenue and earnings. So the two hallmarks that we look for, top line revenue growth and earnings growth, I think that's a pass here. It's a miss. Let's keep going and see what else this is going to reveal, because I think it's going to be really interesting. To finish this chart out, we're going to look at enterprise value. The way we value a stock, it's at the enterprise level. It's as if we bought the entire company, because we're not too concerned with the machinations of the stock market, the up and down randomness that is the stock market. We want to own a business for a decade or more. We want to believe that we own the entire thing because we want to be in that business. If you want to be in consumer discretionary, this is the company you want to own. Let's see if the numbers pan out. So we look at it as a enterprise value, and that would be market cap plus debt less excess cash to be enterprise value. So picking up on the debt, you can see debt $42 billion to $40 billion, roughly flat. So flat debt, declining revenue, declining earnings. They do have cash, excess cash on the balance sheet, which is nice to see. So in theory, they could dividend that out as a special dividend, or they could buy back shares to increase the outstanding ownership of the shareholders. Market cap, that's shares outstanding times price. I add all that up, less the cash gives me enterprise value. Over here, this section, these are our ratios. So when you value a company, when you value any business, you want to market to market somehow, and the enterprise value to EBITDA is essentially the number of years you need to hold the business to get your money back from the business. So it's EBITDA, which is our enterprise level of cash flow. If you held this business on average for 16 years, you would get your money back, or the business would have generated its money back for the ownership. And what you're going to notice here is actually pretty strong growth in this number. Now, what does that mean? That means with flat EBITDA, the business is growing in value. Look at the market cap. Market cap is $183 billion to $312 billion. This change in value is not driven from earnings or cash flow. That's been flat or declining. It's driven by people paying more for the same level of cash flow. That's simply an additional premium. I'm not too sure why a company with zero growth of revenue and earnings would be trading at 20 times earnings last fiscal year. That's frankly surprising to me. It's currently trading. In fact, if I just update this, that's the current market cap to debt, enterprise value to EBITDA ratio is, I'll put that back up for you, 19.8, so still 20 times. It's still expensive. You need to hold the business for 20 years to get your money back in a company that has no growth. That doesn't smell right. So let's keep going. But on average, the way we look at things, average, you can expect this company to trade at 16 times. The thing here is if you hold this for a decade, if we're assuming that it's going to return to the average multiple, that means earnings, the market multiple of 20 times is going to come down to 16 over time. And we're going to use that. It's going to limit our growth potential. So that's the enterprise value to EBITDA. Let me just put this back. Now let's look at debt. So the next hallmark of a solid investment for us is a solid balance sheet, and we measure that by debt load. If they're too heavily levered, then if they stumbled with earnings, your equity position could be in jeopardy, and that's a problem. And if we're holding for something for so long, we need to make sure it's going to be safe. So we look at debt to enterprise value, the number of years it would take to pay off all debt, and that's good. That's under 3. So if you see a number under 3, that means it's a very solid balance sheet. A bank like J.P. Morgan, Wells Fargo, so forth, will typically lend a business up to 3 times EBITDA. After that, you have to go to more junior capital, which is your high interest, high yield kind of stuff. To have a business that doesn't need a high yield is good. So I think from a debt level, it looks great. Revenues decreasing, earnings decreasing. Growth has happened because people are paying a premium for the same cash flow. That's a problem. Let's go look at cash flow. All right. Cash flow from operations. Cash flow from operations in 2011 to 2019 started at 13 billion and has grown to 15.2 billion. Kudos to them, right? So flat revenue, flat earnings by EBITDA, but growing cash flow, that's okay. Grow at 2%, slightly above inflation. Nothing to write home about, but it's got some growth. CapEx here is pretty stable, basically $3 to $4 billion a year, and there's ample room here on the cash flow to be able to pay for CapEx entirely out of cash. That's what we want to see. This business has a lot of free cash flow after CapEx. So just to refresh, CapEx is the cash that they need to reinvest in the business to maintain the operations. So it's new paint on the walls, it's new air conditionings, it's new machinery to keep the assembly line running. It's new software for enterprise software and so forth. It is what do you need to put back in the business to continue running. It's not acquisitions that they make. It's just kind of the ongoing cash. CapEx, debt payments. This is both the inflow and outflow of debt, the net debt that they may issue or have to pay. That gives us to a free cash flow to the equity holder. This is cash money that you can distribute to the shareholders. It's different from earnings. Remember, earnings like EBITDA, that is an accounting metric. It's not cash. This is pure cash. Shares outstanding. It looks like shares outstanding has decreased 1% on average over that rough decade time frame, which is good. They're using the free cash. They're buying back shares. So if you own the stock, you're going to own a greater percentage of the company over time because there's fewer shares. Free cash flow to equity per share, share price, a yield, and a growth rate. So what you'll notice is that the free cash flow per share is growing at 1%. Earnings are declining. The growth is coming from buying back shares and getting a little bit better at the cash generation over time because cash flow from operations is growing. So they have cash flow, it's growth. Now what do we do? All right, we've looked at the business. Revenue is decreasing, earnings is decreasing, cash flow is growing slightly. Let's forecast. So we're going to forecast with two methods. We're going to take free cash flow and string it forward, and we're going to take the EBITDA and string it forward, come up with two different valuations. We'll average the two to come up with what we think the future value of Procter & Gamble is. So we'll take the cash flow first. Cash flow, I'm picking up $4 here which is basically the average of the last couple years, right? And I'm growing that at 10%. They were growing their cash flow at 10%, and I'm decreasing that over time just to build in a little more certainty, a little more cushion for us as the equity holder. I don't want to give too rosy of a forecast because you end up paying for that rosiness. So I want something that's pretty conservative. This is growing at 8.5% over that decade time. I then apply a yield to that cash flow, the average yield that you saw earlier, and I get $175 as a future price target based on free cash flow for Procter & Gamble. EBITDA. Okay, now we covered EBITDA before, and EBITDA growth was negative. How do you forecast a business with negative EBITDA growth? I don't know. Do I assume a turnaround? I don't want to pay for it. Again, if I put something in this forecast, that means I'm buying it. And I'm not willing to lay my money on the line on the assumption that they turn it around. So I've given zero growth. I'm not doing negative, but I'm also not willing to give them credit for growth that's not there. So I held EBITDA constant. I also applied, you'll see, a lower market multiple over time. I think this stock is gotten bid up because of the coronavirus as everyone's diving into what they would perceive as a safe stock, and it relatively is. I mean, it doesn't grow, it's flat. So to that extent, it's safe, but it's been bid up because everyone's diving into it and the multiple's too high. So as the multiple comes down over time, even if they're able to get some growth in, the drop in multiple is going to suppress any stock increase that you might experience. So we're going from roughly 20 times enterprise value to EBITDA to roughly 16 times enterprise value to EBITDA. So I think the future enterprise value of the stock is $262 billion. Less debt plus cash gives me a market cap of $228 billion. Shares outstanding, now they are buying back shares. They're taking that free cash flow, they're buying back shares, fine. So I've carried this 1% a year cash flow, share buyback into the future. I'm assuming fewer shares outstanding in 10 years. So they got 2.12 billion shares outstanding. Had to think of the zeros on that one. To give me 104, call it $105 a share. So we have 175, we've got 105 right here. These two methods, two different ways to look at the company. Market multiple, cash flow. I'll average the two because I don't know which one's right. So I come up with 140. 140 bucks is a good swag at what we think the price might be in 10 years. Now the question is, if we have our price target in 10 years, what is the economic return here? The current price is 118, so there is a delta, 118, 140, but it's going to take me 10 years to realize the 140. What does that look like in an IRR? Well, let's go to our trusty handy dandy IRR calculation. What we're doing here is I've got a purchase price of 118, that's roughly today's value. I've got the cash flow that's generated. They can buy back stock or they can kick it out. And then at the end, I've got an enterprise value, I've got a market price of $140 a share. This is our stream of cash flow. I discount those into an IRR and I get a 7% IRR. That's an annual rate of return of 7% if you buy the stock now, hold it for a decade, and these numbers pan out. Now, all of this is a math exercise. In every video I do, I run through this. It's a math exercise. You have to ask yourself, does this smell right? Right? This is the science piece of finance. The art piece is giving it the smell check. And it smells right to me. Right? You've got a company with declining revenue, declining earnings. Free cash flow is good, but you can't have free cash flow go up forever if you can't grow revenue. They're buying back shares. They kick out a hell of a dividend. And the market right now is seeking income. It's seeking safety. So people are rushing the stock, and that's why you've seen the stock appreciate recently. So over time, as other growth pans out or the market changes around, I can't imagine the market multiple for Procter & Gamble with level to flat earnings going to 25 to 30x times. It just doesn't make any sense. So as it comes down, it's going to cap your return. 7% is the annualized return, 1.7 times cash on cash. If I were to show you a kind of distribution of what returns could look like as the price falls or as the price increases, please reference this video in the future. If 6 months from now you want to see what Procter & Gamble looks like, obviously it's not going to be at 118. We don't know where it's going to be, but it could be above or below that. And then you want to see if I bought it at that point. So if I bought it and it was $86 a share, and we assume the future value of the stock didn't change, nothing underlying changed, they didn't figure out how to grow all of a sudden, but let's just say the stock falls for some reason and it's now $86, you could buy this stock and you would get a 12% economic IRR over the decade, which is a very good return for a company that doesn't grow. It's basically a dividend machine. And to have a 12% dividend over time is fantastic. At a 7%, that's not great. I like this channel. We like to see a little bit more growth if we're going to expose our cash to equity. So for that, I'm going to give it a bad rating. And I'm only giving it a bad rating as an investment. The company itself is fantastic. I use half the products on that already anyways, so I'm definitely giving them my money. But in terms of an investment, if I'm looking for double-digit growth over time for my financial goals, this is not the stock to own. Maybe if it drops under $100, we'll start looking at it. But right now, it is fully priced, and it's not something we want to own. So we're going to pass on it. All right, my name is Cameron Stewart. This is Rational Investing. Thank you very much for watching. Please comment. Let me know what other stocks you want to see. I'm always trolling through comments, and I really appreciate it. And always, please subscribe if you like the content. Thank you very much. Bye-bye.